Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Dane. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is sponsored by ARC Silver Gold Osmium. They offer personal service and often the lowest price, period, with no minimum purchase for silver, gold, platinum, or osmium. ARC SGO is available to discuss precious metals by email, phone, or in person at their retail location in Jackson, Wyoming, and they are committed to providing the best prices out there and making sure you get the best value and lowest premiums on their wide selection of products. Go to arcsgo.com and contact the owner, Ian Everard, at 307-264-9441 or Ian at arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest is a best-selling author and economist who uses demographics to forecast major economic trends and events. We're going to get his outlook for commodities, his predictions for the stock market, the global economy, and more. Somebody I've wanted to have on for a long time now, so it is a great honor, Mr. Harry Dent. Welcome to the show.
Oh, nice to be here, Jesse.
I want to get started with the broad market first because the S&P and NASDAQ keep making new all-time highs, grinding steadily upwards, while simultaneously we see a lot of alarming economic indicators that seem to be flashing red that we could be headed for a recession. I'm wondering if we can have both a recession and a strong broad market simultaneously, or do you expect a correction in the broad indices being held up by this handful of seemingly overvalued tech stocks?
Yeah, Jesse, you really can't have both. What the markets are hoping for here is the all-wonder soft landing, which frankly has never really happened, okay? That's always the hope. The truth is extremely simple. The greater the boom, the greater the bust. We're not just in a boom era like we were from 1983 to 2007. We are in a bubble boom era. First tech bubble peaked in 2000. It crashed. The NASDAQ crashed 78% with a bear recession. That's how big that bubble was. Well, we had a second bubble, and this has never happened, Jesse. The last bubble era was the early 1900s and roaring 20s. A second major bubble that peaked in late 2021. And now, as you were just commenting, just a few large cap indices, the NASDAQ 100 only, S&P 500 only, and Dow, not the broader NASDAQ. And the Russell 2000 is 24% away from a new high, which is a huge divergence saying, hey, unless we keep rallying strongly for many months and the S&P and the Russell 2000 catches up, this is classically a sign of a major long-term top. Now, why is this important? The demographic top was back in late 2007. That's something I was forecasting in the early to mid 80s when everybody thought America was done, Japan was going to take us over and turn us into slaves and all this sort of stuff. And I was saying, no, we have this giant baby boom, and we have the leading boom still ahead in the global economy, and it's going to be a global boom on top of that. And of course, so since 2007, that's when the game changed. For the first time in history, central banks, you got to remember the Federal Reserve was only created in 1914. And in the roaring 20s bubble, they'd just been around. They didn't have the power or expectations. They're just supposed to keep the money supply in rough balance, okay? Well, now they're supposed to fight all recessions and keep the economy growing no matter what, which is absurd, okay? The economy needs to boom and bust. We need inflation and deflation. All of this stuff is part of the natural cycles in why free market capitalism has made us 8 to 9 times richer just the last 125 years. And here we are. For the first time in history, central banks have waged war on the free market capitalist system. Oh, well, we don't like it when we get a deep recession like 2008-9. You know what, Jesse? If they'd have let that go one more year, which would have been natural, we would have weeded out all our excess debts and zombie companies, which are both at record highs now instead. And we would have been over the baby bust slowdown, natural slowdown in the economy, nothing wrong, and ready for the millennials starting in 2024 to start their boom. And instead, we're starting the millennial boom with a super overvalued stock market and all markets, and a recession almost certain because we've overexpanded and we have such massive debts that we never let reset. The great thing about people hate recessions. Recessions do all the hard work. All the innovations happen more in downturns, not in upturns. The upturns are to take the innovations and move them mainstream in a favorable environment. But the real innovation and potential for growth is created in downturns. So this goal that the central banks seem to have out of somewhere, I don't know who told them this, that they're supposed to fight recessions at all costs, is absurd. It's the worst economic policy in history. And I hate to say it, Jesse, I'm rooting for them to fail. We need to have a stock crash now. It's way overvalued, that weeds out this stuff against their, and what did they do? They so overreacted. And this was the huge mistake. They so overreacted to COVID, which was a natural downturn. Nobody caused that, no bad policy. We got all sick for a year or two. And like the influenza of 1918 to 20, there would have been a slowdown, and that would have gotten a lot of excesses out of the markets and stuff and bubbles and all this stuff. But no, they had to stimulate harder than ever. $10 trillion in combined fiscal and monetary stimulus in just a couple years from 2020 to 22. And now we suddenly get 9% inflation. And now they suddenly have to tighten the most since 1981. What happened when they tightened in 80, 81 like that? We had the deepest recession since the Great Depression at that time. Now we're going to have a deeper downturn, I say, than 2008 to 9. And we need it, by the way. And if investors just get out of the way here while things are still up, stocks, bonds, everything, commodities are even reasonably healthy here. Everything's going to go down in this everything bubble. And that is the biggest difference of today versus something like 1929, which was the last bubble era. This is a global bubble in everything. Everything bubbled. And guess what the lead bubble is? Good old Bitcoin. That's the number one thing I watch. Bitcoin tends to lead stocks, and crypto by about 2 weeks. And it's the lead bubble in this bubble, like the dot-coms and Amazon were in the late 90s bubble. That was the first tech bubble. This is the second. And real quick, I'm going to summarize here. Technology and bubble cycles happen every 45 and 90 years especially. So we're 90 years from that kind of 1929 topping process, approximately. Commodity cycles happen every 29 to 30 years, okay? So we had a commodity cycle peak already, 2009 to 11. We're going to be bottoming, I think, in this next downturn, which will be an ideal long-term buy for commodities, because the next commodity cycle doesn't peak until about 2039 to 40. And the millennial cycle for spending to follow the baby boom, which is not as large or as long, peaks around 2037. So once we allow the economy, and I think the economy is just kind of going to force it here, to shake out and have a big correction, and the downturn in financial assets will cause the recession, because there's 630 trillion in financial assets in the world, 6 times GDP when 2 is normal and 3 is normally the high end, okay? So this financial asset bubble is the theme here, not that we have some horrific recession or we have terrible demographics. The demographics are actually positive ahead for the first time, since 2008, okay? But we have not knocked out this financial asset bubble, and that puts a cap on everything. How are the millennials supposed to invest for their retirement as they advance in their careers if everything is overvalued? And the best stock indicators say you ought to expect minus 2% return over the next 12 years. Just nothing about the economy, just at the valuation stocks are price to earnings historically says you got no chance of making money in investments in the next 10 to 15 years. If you're saving for retirement. So this is a needed thing. Governments are fighting it. I hope they lose. I think they're going to lose. This year is the key year because the markets have started to go down, and they did tighten because they over loosened. And that's where they got caught. And you got to remember, I don't care what they do now, Jesse, in positive sentiment, but this tightening is going to be at its worst in early 2025. That's the lag. We won't know how. Everybody's saying, oh, it's not hitting that hard. I'm saying, wait, late 2024, we should really feel it. And by early 2025, we'll know how weak the economy is and how strong this tightening hit. And then I'm telling stock investors, we could be down 60% from the top by then, and it's too late to get out. I'm telling people, be cautious now, just for 6 months to see if I'm right. If I'm looking right, then you might be out for 12 to 18 months, and then you can get back at great long-term values and everything from gold and silver, commodities, stocks, long-term bonds, etc. Right now, everything is overvalued, and actually, commodity sector is the least overvalued. Okay, and stocks and real estate is the most overvalued ever. You will never see a real estate bubble like this again, and 2 in a row at that. And our children, the millennials and their children, they will never see anything like. So real estate, people have to really look at real estate. How much do you love that house? People will sell stocks. They will sell commodities. They will even sell gold, although gold has that emotional value too. But real estate is where people need to look, especially if you have a second home. Sell that damn thing now. It could go down 50 to 70%, and that's never happened in modern history.
Well, for your average retail investor participating in the market right now, what is the best strategy given everything that you've just laid out? Is it to sit in short-term T-bills, money market accounts, and in anticipation of this potential correction? Are there any areas of the market that actually do look attractive? You mentioned that commodities seem to be the least overvalued. Are there any commodities at the moment where you could see a reasonable entry point, or is the best move in your view to be sitting on the sidelines for now?
Okay. Yeah, I don't, commodities may be the least overvalued, but they're also the most economic sensitive, and they will go down further. The real support in like the CRB index is that kind of 90 to 125 area. That's way below the 300-ish that we've seen recently. But stocks, that means commodities might go down 50%. Okay, stocks. I'm looking for the S&P 500, one of the largest cap broad indices, to go down 86%, just back to its 2009 lows, not that far ago. NASDAQ 92%. Okay, and the Russell 2000, the small caps, would be similar. So this is serious stuff. I mean, I've always been a fan of financial advisors, and they used to be my best clientele in the 90s when I was super bullish, and they would listen to me. Okay, I was the most bullish guy in the world, frankly, from the late 80s to early 90s and in the 90s. They keep people in balance, but they're going to tell people, oh, just hang on, we've got you diversified. Look, an everything bubble means everything. There is no diversification that works that well, okay? It just evens you out a little bit. Everything goes down, you're going to lose all your gains for maybe even decades in just a couple years. That is worth giving up maybe another 5 or 10% upside in an already overstretched market for missing a 70, 80, 90% downside. And if I had to be in something, I would take gold over the rest of the commodity complex, because I think gold has maybe a 50% downside, maybe about 1100-ish from 2000-ish, but other commodities could go down much more. I say there's one investment, and when you're in a bubble burst, or what I call a deflationary downturn, and the only comp for that is the 1930s, okay, especially the early 30s. There's only one investment that shines. Hey, T-bills will preserve your wealth. Great. Treasury bonds, like 30-year and 10-year, they are locking in rates at 4.5% now. Remember how much they fell just recently? 0.4% on the 10-year. It's going to go negative very likely in this downturn. Those treasury bonds could literally, Jesse, the most conservative long-term investment on earth, U.S. backed, safest bonds in the world, could double in value or more in the next year or two. That is the secret. Gold is like, hey, if you got to diversify some, gold is the best of the commodities. If you got to be some in there, gold, I think, will still go down 50%. And then I would buy gold, because gold's future is not as an inflation hedge. We're not going to see inflation for as far as the eye see, because it's workforce growth, and baby boomers have entered all around the world, and there's going to be slow workforce growth everywhere, okay? Gold is going to go up because Indians love it. It's a show of wealth in the country that's going to do the same thing China did in the last 4 decades since the early 80s. In the next four, India is going to lead the boom along with Southeast Asia, global boom, coming out of this downturn into about 2065, 67 before that matures. That's going to be where the action is. And of all the commodities in the world that Indians love, and I'd say Southeast Asian too, but particularly Indians, and I've been to India a lot, by the way, gold. So I would love to see gold go back to support around 900, 1100, and that I could see gold going to 3,000 to 5,000 in the next long-term boom, and there won't be many commodities that will beat that.
Well, I want to get into emerging markets in a moment, get your further thoughts on India, Japan as well, not an emerging market, but one that you have discussed in the past quite a bit. First off, I would like to dive a little bit deeper into gold. You mentioned you could see it going down a lot as well, but do you also look at physical gold as a practical way to store wealth outside the financial system, to have some percentage of your wealth in physical gold to, hedge against things like a banking collapse, or just to have some diversification in that sense of your wealth? And then I'd also like to get your thoughts on silver as well, and how that differs from gold in your view.
Well, silver is more volatile than gold. So it's like 1.5x. If gold goes down 50, silver will go down 70 or more. So I would rather, if I'm going to put a diversifier in my portfolio, knowing that it could go down, but not as much as stocks or other commodities, I would choose gold. That would be the best, because gold has that, hey, in a financial crisis, it's real money. Hey, silver does too, and I wouldn't mind having some bags. If I wanted emergency money and things really get bad for a couple months, I want bags of silver coins just for trading of things. I don't think they're going to get that wonky, but it is possible. I mean, I am, from my point of view, predicting the greatest financial crisis of our lifetimes, future and past. You would have to go back to the early 30s, and all central banks have been doing, Jesse, since the 2008 crash, which I predicted decades in advance, that we would top in 2007 with the baby boom, massive spending wave, and go into a long downturn from 2008 to 22, 23. Predicted that back in the mid 1980s when this boom was just starting, okay? So this is real, and so we have to basically, I'm hoping the economy now, because they've tightened too much, too fast, that the economy does go down enough for financial assets to collapse faster than the Fed can keep up with, wash out this financial asset bubble, wash out a lot of bad debts, and therefore maybe by 2025 sometime, later than normal, we should have been booming from 24 to 37. We'll see that millennial boom, and it will be on better foundations because we won't have all this financial assets that can't go up any higher because they're overvalued, and massive debts that have not been allowed to, restructure. Restructuring debts is everything. It's healthy. I was early in I was Bain and Company, turning around Fortune 100 companies, got bored with them because they're so large, and started doing the same thing in California with small, high growth new ventures. When things would go bad, I could cut overheads and costs 5x in half the time. When I'm not, and so downturns are actually an opportunity, and we need this. We have what I'm going to call, my next book's going to be called The Last Great Boom in America, something like that. This is it. After the millennials, we got nothing. Okay, we're just like Europe and the other developing nations that have been peaking, and will actually, Southern Europe contract forever. East Asia, Japan, Korea, China contract forever. China's going to lose 40% of its population in the next 50 years, and it's supposed to be the next great thing. It's not, and it's already got 22% empty houses, enough to fill every urban migrant for the next 40 years until they're totally mature at 87%. China's done. India is the next big thing. Southeast Asia is the next big thing. And the U.S., especially in our tech sectors, the NASDAQ and stuff, is still the leader in the world for now, okay? And we have this millennial boom into 2037. And after that, it's going to be hard to recommend the U.S. as a long-term investment, but not now, and especially not in the tech sector. So there's plenty to do here. I still say the opportunity here get out of the way, give it a year. 2024 is this pivotal year. Are they going to be able to stop this again and keep the bubble going a little longer? I say no. I think it's already starting to get ahead of them. But we'll know by the end of this year. We'll have a better picture by early 2025. And then if we see a major crash, which is the most likely scenario in my scenarios, then it will be the opportunity of a lifetime to buy stocks in real estate. And I would way rather have stock. Real estate, people don't understand. The problem with real estate, Jesse, is when people die, they're sellers. Guess who's going to be dying into 2041 in increasing numbers? The largest generation in history. The very people that created the greatest boom in history from 83 to 2007 now have a dying wave into 2041 that is going to hamper everything a bit. So if we don't have a good shakeout here, it's going to be hard to find good values in stocks or real estate again. If we do, then in the right areas like retirement areas for baby boomers and still maybe starter homes for millennials, there's going to be some traction in real estate. Commercial, I'm not going to be that interested in because I've been working out of my home since 1989. Call me a trend leader, okay? I would never go back to an office again and waste half an hour, 45 minutes each way commuting and then spending half my day in gossip.
I would like to get some more insight into your thoughts on emerging markets. You've mentioned India a few times. I'm wondering if you see any emerging markets. Brazil is another one that's come up in conversation before with some guests on this show. I wonder if you see the setup for emerging markets at the moment to be favorable at all. Is the same problems facing the US, both the stock market and the economy, does that apply to emerging markets as well? And do you ever look at frontier markets, places in Africa, Kazakhstan, places like that?
I don't look at frontier markets as much because they're way more volatile and hard to predict. I'm looking at things that are, once you get like the 10% on an S curve, the rest of it's far more predictable, okay? And once a country gets to a certain maturity level, at least second world, okay? Then you know, demographics and technology cycles and stuff become more predictable. But in that really early stage, it's just too rich. That's for an investor that's specialized in that. I don't think most people should be in that. What I'm telling people, the best global areas are very clearly, no question about it, no longer China ever again, okay? If it goes down, fine, but why would I want to buy China down when Southeast Asia is going to be down and India is going to be down? And that's where all the growth, almost all the growth in Asia is going to be concentrated as it was in East Asia and China, now in Southeast Asia moving to India. That's where the action is going to be. These markets are overvalued now. I just looked at the Indian chart the other day for a client and stuff. And it has to go down. People say, well, why don't I just buy India, Harry, if you're right? Because India has bubbled up with everything else, and everybody knows it's the next big thing. It's still early stage, but we need to wait for even these emerging markets. But here's the secret, and here's my simplest graph. I show the whole demographics of the developed world. It is peaking here and slowly declining for decades to come, and the emerging world just keeps going straight up into 2100. That's demographically. Once they urbanize and get there, and then it'll take them up to age 40 to 50 to mature demographically in these new cities and new growth areas, urban areas. And that's how we fulfill my biggest cycle, the 500-year cycle that peaks around to 2140 to 2150. So that is India and Southeast Asia are going to lead the next major global boom. It will be in Africa too, obviously, no question. Emerging markets are going to be basically all the net growth in the world. Developed countries, all in summary, Europe, North America, Australia, New Zealand, Japan, South Korea, East Asia. Those countries are all maturing, moving sideways at best. It's all the emerging world from out here for growth for investors. And of course, again, why be everywhere? Southeast Asia and India, plenty of opportunity, and there's going to be plenty of funds growing there and new funds. That's my next step for my subscribers. In the next year, I'm going to really be studying the best emerging markets funds in India and Southeast Asia.
Well, you correctly predicted Japan's lost decade, and now we're starting to see strength in the Japanese market, but we're also seeing headlines that the country has officially fallen into a recession. So, what do you make of the Japanese market at present?
Dead. Dead now, dead forever now. But I was also predicting they had their millennial boom. They came early. Okay, they peaked actually demographically in 96, but they had a tech-like bubble like we did in 89 that crashed first and never saw new highs. So stock market, they peaked in late 89, but demographically, they hit their peak like we did in 2007 in 1996. Japan went down, down, down. Then they had their millennial boom, and that just peaked recently around 2020. So this is it for Japan. They saw their highest high, 89,000 Nikkei back in late 89. They came back and they're retesting that now. It will not get much above that, if any, and it will go down for the rest of our lifetimes. Anybody over 40 listening to this show, you will never, ever see a new high in the Nikkei again, ever in your lifetime. That's my prediction, and I will lose no sleep over that. They're lucky. They shouldn't even be here. They just got caught up in the last of this bubble where everything's bubbled, okay? So Japan is really overvalued here, given that people don't know that even their millennial boom already peaked and does nothing but go down for decades. Never turns up by any demographic projection I can make. Japan is the first dying wealthy country in the world, and all other wealthy countries are going to follow. And you know who the luckiest ones are? My favorite country to speak in market, Australia and New Zealand, especially Australia. Why? High quality, high income immigrants from Asia. They don't get people crawling across the border penniless. They get immigrants from Asia that are as smarter and higher income as they do, and they get them in higher percentages than we get penniless immigrants. And those penniless immigrants I'm happy to get. Most of them work way harder than we do. I am definitely not anti-immigrant. I'm just anti-endless illegal, okay? So this is where the action is. And Australia, New Zealand are the only developed, and Scandinavia, Sweden, Norway, Finland. Those are the 5 small, wealthy countries that still have some demographic growth in the future. Everybody else is flat to down and mostly down. That's a different world. Emerging world is going to count for all the growth. So all investors need to be putting a sector of your portfolio in emerging markets. Just don't do it now. Wait for the next big crash, because it ought to be a big one when it happens.
You mentioned recently in one of your rants on YouTube that all cycles are negative right now. So talk to us about the different cycles you're observing. You mentioned a few already, one, this 500-year cycle. I'm curious to hear more about that. And why should people be paying attention to these cycles right now?
Okay, people don't like cycles. You know why? Because every cycle has a winner and nobody likes winner. That's why. And that's just stupid. Cycles are your friends. And the problem with cycles on one side is there's infinite. I mean, especially you get shorter term, there's more and more cycles. What I've done, I've spent my whole last 40 years, identifying what are the few cycles that over time have demonstrated to matter for the economy, and there's 3 of them, okay? There's a 45-year technology innovation cycle, which is the most powerful. There's a 39-year demographic cycle. Note that major stock peaks, 1968 adjusted for inflation, and then 2007 recently before we got in this endless stimulus, okay? That's a 39-year. Generations come along every 39 to 40 years, drive the economy up until they peak in spending and their kids leave the nest, and then they start to move towards midlife and retirement and become adverse, actually. So, and then there's a 35-year geopolitical cycle that simply just goes, it doesn't affect growth in the world, but it affects how the world looks, and it looks more favorable. Valuations are higher on stocks and less favorable. And we are actually, this is the one cycle that's just turning up now. The 35-year geopolitical cycle should be positive from now into about 2036 to 37 with this millennial rise in spending, which is also positive. So all cycles are negative up until recently. the demographic cycle turns up here and the geopolitical cycle finally turns up. So all we got to do is quit being ninnies and have this damn recession and get it over with. Clean out the bad debts. Bad debts are no good. They're tying up capital. They're unproductive. And there is an indicator, Jesse, that everybody should look up. It's called money velocity. Look at that chart back 50 years. It's been dropping like a rock since 1998, right when the first bubble started in tech, 95 to 2000, and it's continued to drop. The same thing happened from 1917 into 1932 while we had the great roaring 20s bubble. Bubbles are fake booms. Bubbles are not high productivity. Money velocity tells you if money's being invested, giving returns, and being reinvested profitably. Money velocity cannot go up if that's not happening. It's been dropping like a rock, which tells you as an investor, we still have a crisis ahead of us to wash out all these bad debts. That should be our number one goal. Hey, we borrowed a lot of money. Fine. We always do this in booms. It's a good thing to do. But people borrow a lot of money. Some of it will be bad. Second goal, flush out the bad debts. That's what a smart economist would do. That's what the economy is dying to do. Economists and politicians don't want this to happen on their watch. And of course they wouldn't. Well, screw them. Okay? This has to happen for the millennials to have the boom they deserve and for investors to be able to invest long-term in stocks and real estate again and feel good about it. If not, you shouldn't touch anything right now. Nothing. And if I had to buy anything, I'd buy the commodities. But I wouldn't touch anything right now.
And I want to get your thoughts on de-dollarization, on the potential fall of the US dollar. Obviously, in the gold bug circles, there's a lot of hyperbole out there that the BRICS nations are going to come out with a gold-backed currency at some point, whether that's a trade currency they use amongst them. I've spoken to Alistair McLeod, who thinks the Russian economy might actually be moving towards another gold-backed currency. Do you think... I'd like to get your take on where you land on the whole discussion of de-dollarization and the potential for gold to return to the monetary system in some form or another.
That's a super good question. I don't know why anybody wants to be the reserve currency. It just means your currency is overvalued, which means your exports are disfavored as a general rule, okay? But we've been that for a long time and we've prospered despite it. I'm very clear on this. The U.S. dollar, if we have to work out a crisis here, in the crisis, and look at 2008, Treasury bonds of the U.S. and the U.S. dollar did nothing but go up into late 2008, and then they come down, okay? The U.S. dollar, I think, will go up one more time with this crisis, and you know what it's going to do? I think the whole rest for years and decades to come, it's going to slowly go down. We're no longer the dominant global leader. All the growth is going to be in Asia. We're going to grow in our tech sectors and to some degree because we're the leading country in a dying developed world, okay? We're still the leading country. So our dollar will hold up best and go up. And then I think the dollar will be not the place to be long term. You're going to want a basket of Asian currencies or something like that, and I'd be happy to bet on the Australian dollar after all this, because they're the only Western country with good demographics in the leading part of the world where all the growth is going to be, Southeast Asia and India. No Western country is closer to that than them. So the U.S. dollar is fine to be in now. You'd be making a mistake. But the best way to buy the U.S. dollar is to buy 30-year Treasury bonds, or if you want an ETF, TLT. That's an average of 10 and 30, so it's average 20. I think TLT, as I said earlier, these Treasury bonds could double or more in the next year or two. And you know what you do then? You get out of them. They are not a play on the next boom. Inflation is going to be extremely low and stay low, so no action there. Low yields. There's no need for safety once we've washed out all this terrible stuff out of our economy. So it's only when I buy treasury bonds, people are like, well, I don't want to hold those loans. No, we're talking only in the downturn. It is the hedge, and people think gold is the hedge, and gold did fine in 2008 until the second half, and then it went down 45%. Now, 45% look good compared to other commodities and stocks, but gold was not the safe haven in the end, but it overall was only down for a short period of time. So if I had to be in any commodity safe haven, I would choose gold. But my safe haven, 30-year treasury bonds, single best, 10-year treasury bonds, second best, AAA corporate, third best. Those are the three places that benefit from deflation and a slowdown. And since we're in an everything bubble, everything else, all other bonds with any risk, just normal corporate bonds will go down because of recession risk. And this is going to look like a depression to me for a short period of time. Okay, so that's the game. And when we get out of this, then I want to be in Asian, India, Southeast Asian oriented stocks, tech stocks here, and gold would be the commodity of my choice to diversify there for the next boom. I think gold will be the best commodity beneficiary in a world where India is the next China. And I'm telling you, nobody on earth, any country I visit, love gold. Poor people have gold jewelry up and down them, okay, as a modest display of wealth. So gold, I think, will see its best days, and not because it's got to be a damn inflation hedge, because it's a valued commodity in the fastest growing countries in the world.
And do you think we could see gold return to the monetary system in one form or another? Is that just a gold bug fantasy, or do you think it could become a reality?
I think it is now. It was the best standard. Remember, the world was material, okay, up until the last century. Everything was, cars at best, and steel, and iron ore, all this stuff. It's material world. Gold was the perfect standard. It's concentrated. It's valuable. It's durable. It's limited. Well, it's not now, okay? We need something, the best standard now, and I'm pretty darn clear on this. I wouldn't bet my life on it. I'm betting by the top of this next boom, 2037, that Bitcoin is going to become the global monetary standard. And you know what it's got to do to have is more than all the gold in the world, and be able to be that and still grow with a digital world, which it is digital. It's going to have to worth $1 million plus a coin. I see that for Bitcoin. And I wouldn't buy Bitcoin now. I think I want to see what happens when stocks crash next. And wherever Bitcoin ends up in that, I would buy it and hold it for a long time. I'm hoping it gets as low as 3,000 to 4,000. If it just got back to its recent lows after going to 52 here, back to 16-ish, wherever it is in this next crash, it would be my lead. If I had to buy one thing in the next crash and one thing only, it would be Bitcoin.
Fascinating. As somebody whose first investment was Bitcoin and a true believer in that commodity, that warms my heart.
Well,
so let's end it on.
It's the only large enough, potentially neutral potential gold. There's nothing else that's neutral, including gold. U.S. dollar, give me a break. Everybody wants to take us over and put us in our place, It's the only, to me, Bitcoin's almost a slam dunk to be this new standard, and it has to go up. I have a projection just comparing it to Amazon and the .coms, which is very similar so far, including this crash, okay, in which says it should have some more. It's projecting 780,000 to me by 2035 to 40 in Bitcoin. And that wouldn't necessarily be the end of it, but imagine you could buy Bitcoin anywhere from here, but especially, let's say, if it just goes back to its late 2018 low, that's what I'm just dying for. 3250 to 4100. And that, if it gets in that arena, oh my God, I'm going to have a hard time buying anything else. Literally, at least for a while.
Well, this has been an extraordinarily fascinating conversation, Harry. I really appreciate you coming on. For those who want to learn more, could you tell us about the HS Dent forecast and anywhere else you want to direct people online?
Yeah, really simple. The best thing, go to harrydent.com. There you go. We have hsdent.com, is the website, but that's where you get on our free weekly newsletter. You're gonna get an article from me every week and a video or two a month just to get to know us, okay? And then we have a paid newsletter, and it's very affordable. It's something like $249, but you can get on our free newsletter now. Just go to harrydent.com and sign up. That's the simplest thing to do. and you're not going to go wrong with that. This is a time where you cannot afford to listen to the traditional wisdom, because they're all going to say, oh, it's okay, you're diversified, we always go to new highs. I'm telling you, there's a lot of things that will never, ever see a new high in your lifetime. That's how extreme this double bubble has been. And anybody who understands bubbles would know these bubbles have not gone back. We have not knocked out. We need one more crash to knock out these bubbles. And it is not safe to buy hardly anything except for treasury bonds until then.
Great. Well, I'll put a link in the description below to harrydent.com. Thank you once again for coming on the show and sharing your knowledge with the audience.
Thank you, Jesse.
And thank you for joining us today. As a reminder, this episode is sponsored by ARC Silver Gold Osmium. Get in touch with them at 307-264-9441 or by email at ian@arcsgo.com, and be sure to let them know Commodity Culture sent you, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.